Broadcast is now starting. All attendees are in listen-only mode.
Hey, everybody. Happy Friday. Everybody survived the stock market crash of 11 a.m. to 12, whatever that was. Almost finished in positive territory. Hey. Everybody can hear me okay, I take it, since I'm getting a lot of replies. Sorry if I don't reply to everybody. Welcome back to several of you, and welcome to most of you, it looks like. JQ knew it would come back. Jane Wells was the first person I saw tweet out. She was like, stock market's going to be in positive territory by the end of the day. Well, she was a little off, but not much. That was a huge comeback. S&Ps, I believe, or E-mini S&Ps, I think were higher than they were from the open last night anyway, at the end of the day. Hello, Mary. David wants to buy some Netflix calls. We can look at doing that today. Just remind me to throw it out there when we're doing the question, or when I'll give you guys an opportunity to throw out some of your stocks. I'll sell you mine. I might buy them. Might let you off the hook. Although I don't know if it's a good sign. We just got rid of our Netflix subscription. They made enough money off of us for a long time with us not even using it. I think I may have watched one Netflix movie in like a year. It's like having that gym membership, right? That's how gyms make most of their money, is they sell it to people that never show up. David, you bought Netflix and got rid of yours? Bought Netflix calls when you got rid of it, or you just never watch it? Oh, never watch it. Hey, sorry for you guys. A lot of you guys I see are returning from last week. Sorry, last week's taping got screwed up, so we had to kind of do it again. So that's why you didn't get it right away, like I had kind of promised. Hopefully we don't have that same issue this week. For some reason it stopped recording midway through. All right, give me a second to set this up, record, and hopefully it will record the whole webinar this time. Okay, this is being recorded, you guys, this time. Last week, I'm sorry about the snafu, like I mentioned, but one thing I mentioned at the beginning of all these webinars, and it sounds like a broken record for some of you that watch these constantly, is watch this again relatively soon after going through this webinar. For one, when we're going through this, there's going to be a lot of information thrown at you, even if you're a newer trader or a savvy trader for that. I'm going to be talking about some things that you may not have learned before, and you'll be thinking about different questions and might miss something along the way. So go back and watch it again, because it'll make it stick into your long-term memory. I'm going to be talking about things that you can't really go online and find anywhere. So I know you can go online and find out how to do a long call spread, but I have specific rules that aren't out there that you're going to kind of need to know. So watching it again will help you solidify some of these rules in your noggin. All right. So this is a part of our option series, options for beginners, but I'm actually trying to build this so that even if you've been trading options before, you will be able to take something away from this this long call spread webinar. Okay, So stick with me. Anyway, some of the stuff will be, remedial, I guess, for lack of a better word, but other things you will be able to find if you are a long-term trader. All right, so my name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money since college. I went to college for a psychology degree and invested some money I had earned before that in high school and even in middle school. And started trading stocks, buying stocks for the most part, was thinking just for a long-term investment, and then got into selling options against those and playing around with that. And that's kind of where I became a trader, I believe. And then decided to switch my psychology degree over to a finance major. I still have a psychology minor, but finance major. And in that time, I basically traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products, basically in all market conditions. I've seen those kind of tanks like we saw today, as a matter of fact, a 380-point sell-off and then snap back to almost unchanged. So I've been through that, and those are the days on the floor where we look like this. All right. Got to go over this disclaimer real quick. It says any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and associated companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of the securities or strategies. And the reason why, you guys, I don't know what's in your portfolio. I don't know your investment prowess. I don't know your risk parameters. I don't know how much risk you're willing to take. So take what we teach you in this and implement it into your portfolio in your own way. I'm going to try and give you some guidelines to follow, especially on implementation, to help increase your probabilities of success, and where I usually get out, and some guidelines as to where I think probably just about anybody should get out to increase your probabilities. But please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Also, you can follow us at ProTrader Strat. That's ProTrader Strategies, the parent company, and you can follow me personally at Wolfman's blog for all kinds of investment wisdom from me, hopefully, and or snark for that matter. There's always the Wolfman hacks to take away. That's absolutely right, Farshed. Hopefully, if nothing else, you can take away some of those hacks I learned on the floor so you don't have to spend all your time trying to figure out what everything is. And we'll go over a little bit of that right now. So some of you guys that watched last week's video, I'm going to be throwing these out here right in the beginning just for the very newer traders or the people that haven't seen the previous webinar. So just want to go over this real quickly. Delta affects the option premium in relation to the underlying for the first dollar move. Okay, so basically what that amounts to is, if we go over to the platform here, we can look at delta, gamma, theta. Once XRT moves up from $43.52 to $44.52, that first dollar move will increase this strikes premium, the 43.5 strike premium, by 80 cents. Okay, let's just call it right in between the bid and the offer, somewhere in between there, or by 75 cents, somewhere close, or sorry, this from 75 cents will increase by the delta of 51 cents. So if we said the strike was trading at 75 cents, we add the 51 cents to it, and that gives us $1.20. What is that? $1.26. Okay, so the delta increases the premium value on the first dollar move. That's one way to look at it. There's also several other, like Farshid mentioned, are the option hacks that you can look at delta for. It'll give you a lot of other, like 6 different things that delta actually tells you, but I'm not going to really go into that much detail on these right now. And then gamma is the rate of change in delta, and really what that is it's just the second dollar move. Think of it that way. The first dollar move is delta. The second dollar move gamma gets added into delta. So when we gave that first example of going 43.52 to 44.52, this premium increased from 75 cents, add the delta in, $1.26. The next move will have this gamma added into it. So it's going to be like 72 cents. So from $1.26, add in 72 cents, we're going to get $1.98, right? So this premium would, on the second dollar move, would be worth $1.98. You can almost look at it usually when you kind of flip down here and see a couple dollar moves would be close to that. But then, and then third dollar move is going to add in the next delta, if you will. All right, and then theta is going to be the impact of time on premium. This is also the thief in the night that comes and steals your premiums, is what we used to call it on the floor. But what it does is it is the decay in this premium per day. So this premium, if all other things remained equal, meaning volatility didn't change, the price tomorrow at this time was, if we were open tomorrow, the premium would be less by 2 cents. So this would go from that example of 75 cents and would be worth 73 cents tomorrow. Yeah. Okay. And then Vega is a measure of change in volatility. And Vega basically will increase or decrease that premium value by the rate of Vega. So if volatility goes up by 1 percentage point, then from basically 74 to 75 here, this is going to increase by the volatility, which is 0.04. Okay. All right. So having that out of the way, let's get on with building a long call, you guys. So I like to build this long call, or sorry, I should have gone building a long call. I like to build the long call with an in-the-money option. The reason why is because it's a low probability strategy. And I like to try and isolate. If I can't take advantage of theta or the decay in those options premium, I want to isolate it. I want to get rid of theta, that thief. And the way to get rid of that thief is to do it with a long call that is in the money. Now, if you're doing it at the money, you're going to have theta decay, all right? But this first one that we're buying, I like to do it in the money. And I like to buy that in the money call at right around an 84 delta. And the 84 delta, why is that significant? That's like a 1 standard deviation move. That means that this probability of my strike being in the money at expiration, there's an 84% probability. That's pretty good, wouldn't you agree? I mean, if you think about the odds of something happening, it's 84%. That's pretty good. And then I'm going to be selling an out of the money call. Now, the way I like to sell it is, where I like to sell it is to pay for that extrinsic value of this in the money option. Now, what that means is an in the money option has intrinsic and extrinsic value. Intrinsic value of an in the money option is what that value of that option is actually worth. So if I pull this back up, if we look at something like the 41 strike, let's just say. Now this 41 strike is in the money. So this premium here has intrinsic and extrinsic value. The intrinsic value is what this strike is worth. So if we take 41 to 43.5, you can see that there is $2.52 in intrinsic value, meaning this 41 strike is really only worth from where that strike is to where it's currently trading. So $2.52. Now you can see on this, $2.52 is the bid, and you will likely not get that because that's what it's exactly worth. Somebody would not be giving up any theta. But so you could say right in the middle there is $2.62. So its intrinsic value is $1.52. The extrinsic, the theta component of this strike, is about 10 cents. Now, Farsh had mentioned one of the trader hacks. One of the trader hacks is to look at the strike, look at the price, and right over here, the corresponding put really gives you a great ballpark as to what the extrinsic value of this in the money option is. That's a little trader hack for you. You don't have to go through and do the math. I mean, sure, this one was easy when we said 62 cents and figured it all out, but we did go through a lot of steps to get there, right? We figured out what the intrinsic value is, what it's actually worth, and then figured out what the fat or what was over and above that value to figure out the extrinsic value. Well, a trader hack is just looking straight over here. It's not perfect, but it is close enough for government work, and it will save you guys a lot of time and anguish over looking at the math on that. So that's a little trader hack, because on the floor, we basically had to figure this stuff out really fast. The first person to make a market on something was probably the first person that got the trade. So it was imperative you were able to figure those things out quickly, and that was one of those ways. So what I'm saying with this is when I'm buying this in the money option, any one of these, and I'm looking at the 84 delta, right? So it would probably be the 41 and a halves. I want to pay for somewhere around, 25 cents, let's say, just for ease of what it is. 25 cents I want to pay for the extrinsic value of this in the money option. So then I would basically just go out here and sell the one I could sell for somewhere around 25 cents. So this would be the one I would sell. And that would pay for that extrinsic value. That way I don't have to worry about that theta component. And it allows you to be in this trade a little bit longer. So we're going to be looking, I usually look at an in the money option, 84 delta. That means I'm going to be basically neutral to bullish, all right? If you are a lot more bullish, you could be buying ones that are at the money or just slightly out of the money, but I would suggest just buying calls at this point, really. If you're going to be taking that much risk, you might as well get paid for the reward if you're correct. So, if you're wildly bullish, like I mentioned in the last webinar, you're bullish like a matador, then you go out here and buy these. I wouldn't even define that risk then, or I wouldn't sell that call to help pay for that because it is defined risk because you're buying it. But if you're that bullish, you're taking a lot of risk on, you might as well get paid for being right if you are. Whereas this one, I'm kind of neutral to bullish. That means I believe it's going to go up. I don't believe it's going to go down. It might stay right here. And if it does, I've paid for the extrinsic value. That means the intrinsic value isn't going to change. So if it stayed right here and at expiration, it was still right here, I wouldn't have lost money. Okay, whereas most options, when you're buying them out here, if it doesn't move, you're going to lose all that premium. So we want to try and pay for the part of the premium that is going to decay. All right. So that's the key takeaway there. If you're buying an at the money option, we'll go through the risk reward on that here in a little bit, like how much you should be willing to accept. So like I mentioned, the way I do it, I'm neutral to bullish. If you are buying the at the money or the out of the money ones, you are pretty bullish. And at that point, like I said, the takeaway here would be watch that call webinar and just buy the calls outright. I wouldn't even buy a call spread out of the money because I'm taking on that risk. I'm already taking on that risk. I might as well get paid for it. All right, so picking the right strikes. So with this, like I mentioned, picking the 84 delta strike that's in the money, paying for that extrinsic value. That's really important here. But in that, when we're doing this spread, we're buying the in the money and selling the out of the money, we're going to be looking for risking one to make one. Okay, so what does that mean? It means like if this spread is $5 wide spread, okay, if this spread is $5 wide, I would need to pay $2.50 or less in order to have the ability to make $2.50 or more. Okay, so I want to risk one, which is that $2.50, to make one. which is the $2.50. If you're doing it where you're buying the at the money call and selling the out of the money call, then my rule here would be you are risking 1 to make 2. All right, so rather than do crazy math on this, let's just say that if this is $3 wide, in that case, if I'm doing the at the money call, I would pay $1 for a $3 wide spread in order to have the ability to make $2. Okay? So if you're starting with the at the money and selling it out of the money, you need to make it where it's risk 1 to make 2, because your probabilities are lower now of making it. So if my probabilities are lower, I need to have a higher reward. It's always a give and take, you guys. And then if it's in the money, my probabilities are higher, so I need to be willing to accept a little bit less profit. So in that case, I'm risking 1 to make 2. Or if it was $3 wide, I'd be risking 1 to make 1. So if it's $3 wide, I would be willing to pay no more than $1.50, and therefore I would be able to make $1.50. You know, if it's off by a couple of pennies, you guys, that's okay, but don't go much more than that, because you need to be paid for the risk you are taking on. I see some traders have the long and short in the money. Why is that? Ed, I don't know why that is, to be quite honest. You know, unless they were, I don't know why you would do that. And believe me, I've actually seen it where it's even really very close. But the risk reward is not there. You know, they aren't taking into account the risk reward. They're risking more than what their reward is able to pay them out. And that, to me, doesn't make sense on a low probability strategy. Do we want to offset the extrinsic by the out of the money premium we are selling? Yes. We want to, the premium we're selling should offset the extrinsic value of this strategy. Now, one thing, and for the newer traders, okay, so a lot of newer traders start out with stocks, kind of like what I did. And I started out buying stocks and then selling calls against it, okay? I never really worried about the downside necessarily, but if you traded stocks and started getting into options like I did by selling covered calls, another option strategy is called a collar. And a collar is a long stock position, and then you buy a put and then sell a call. Okay, so that's a collar. And what that does is limit your downside, and you also limit your upside as well, but you know, you reduce your risk on the downside. This long call spread, you guys, is a synthetic collar. It is, the deltas are the same, the risk reward profile is the same, but you're using about 10 times less the margin in a sense. I mean, it's a lot less in margin. I mean, considering if I go out and buy a call spread, and I'll show you when we do the math on some of these spreads versus what it would cost you to go out and buy the stock, right? You're going to use a lot less, it's a lot less money intensive against your portfolio to do it like this. And it's the same thing. The reason why is because if you're long, and we can talk about deltas here real quick just to get it through your heads, all right? So let's just look at it. If I was looking at this as buying XRT at $43.52, and I bought this ETF, I'm just going to call it a stock, and I bought these puts, okay? I buy these puts. Well, let's start with this. I buy this underlying. When I buy 100 of these, that means I'm long 100 deltas, okay? That means for every dollar move up, I get paid $1. That's 100 deltas. Now, if I bought that, I'm 100 deltas long, and I buy this put, now I have decreased my deltas by 13. So now I'm long about 84 deltas, right? 87 deltas. which really kind of correlates to the 88s over here, right? So I'm basically the same delta as if I just bought these in the money calls. And then when I sell the calls against it, where was I selling those? Somewhere around 27. Then I'm short those deltas. So I'm long basically 55 deltas if I did it correctly here. What is it? Sorry, I did the 88 deltas, and then I sell 30 deltas. That means I'm long 58 deltas. Does that make sense to everybody? So if I'm long the stock, I'm long 100 deltas. If I do the collar where I buy the puts and sell the calls, then I do these puts, then I subtract those deltas from what I'm long, and I've limited my risk below 41, right? If I bought these puts and the market goes below 41, well, I'm out of that right there. I have no more risk to the downside. But I'm only long 84 deltas, or sorry, 87 deltas now. So I'm long 87 deltas. When I've done that part of the trade, I go in and sell these calls against it. I have to subtract these because when you sell calls, you subtract delta, okay, because it's assuming you're long deltas here. So you're selling that. So you sell 30 deltas against 87 deltas, you're long 57 deltas. So that's a little bit more detailed. That's hopefully a nugget for some of you guys that are more savvy. Watch that again, and you go through it, but that's the same idea. But then if you just go in here and buy these same corresponding calls instead of the stock, you're long 88 deltas because it's got a synthetic put in it, right? When we're long an option and we go below here, that option becomes worthless and we have no more risk to the downside. So that's why these calls have like a synthetic put in them in a sense, and that's how it's a synthetic collar. It acts exactly the same way, but you're paying out a lot less. All right, buying relatively deep in the money option is like kissing your cousin. There's no thrill, no significant leverage. Well, that may be true, but what I'm trying to impose here is that, a lot of people get into trading options from trading stocks, selling calls, doing those kind of different strategies, and this is the exact same thing. But when you buy these deep in the money calls, there is the advantage of less margin for sure, and it acts the same way. Like you're going to get paid out the same way as if you did it with stock. Is the real takeaway I want you guys to get there. All right. So picking the right duration. Now, when we're doing long option strategies, mean we're buying them, we want to try and do everything we can to hold off theta. And this is a linear chart or I don't know if it's linear, but this is a chart of what theta looks like to the options premium. It decreases all the way. It never really goes up. And then inside of this area, it really picks up even quicker. So we want to kind of get out here, even though we're kind of getting rid of that theta component, we want to allow ourselves to be right. Okay, so if you get in here, you got to be right really fast. So get out here. We've kind of gotten in that area of where it gives us a little bit more time to be right. Now you can even go further out. I usually try and stay inside of the 70 some odd days. You can even go further out, and a lot of times if it's really close when you're setting this up on that risk one to make one rule, go out just a little bit further and pick those same strikes, and it might even be a little closer. Okay, it might get you a little closer, and it buys you more time. So in the past, I've always kind of pushed people to go to here, but if you are in a well-traded stock like Facebook or Apple or something like that, where there's really tight bid-ask in these front months, and then there's a lot of volume and open interest in those really far out months, then you can sneak your way out here. But if the stock gets really wide way out here, I would stay away from it. Okay. Picking the right environment. With this strategy, I like to have low IV percent. The reason why I like to have low IV percent for something like this is because when volatility expands, it's actually going to help us, despite the fact that what happens is those out-of-the-money options will have a tendency to kind of increase in value or bake in more volatility to them. It's not going to be a whole lot, but it will have a tendency to pump up the premiums in those, sorry, I said out of the money. The in-the-money options are going to increase in value because that volatility is going to increase. So we want to have that probability of the volatility increasing to help us in the near term. If volatility starts decreasing, you're going to see it affect you much quicker on those options you bought. Okay, so just keep that in mind. So we want low volatility. Also, if we're doing this in a high volatility market where it's like above 50, I like to do these in below 30 IV percent. If you're doing this option strategy in a high implied volatility environment, there's a lot better strategies to implement in that type of environment, okay? You want to be using that volatility expansion in your or when it's high volatility, you want to be taking advantage of that high volatility by selling option premiums, and we'll get into that later on in this course. But so right now, you want low volatility because there's, like I said, a lot better option strategies for any other type of environment for one. So something below an IV percent of 30 for this. Anything above that, there's better option strategies that have higher probabilities for you. I see a couple of questions coming. Can you take into account, Rick, I'm not going to read yours. Can you take into account earnings announcements? Yes, you can. You absolutely can. And another thing on top of that earnings announcements, I wouldn't take this through the earnings announcement unless I was already a full boat loser. Like if I was, my 84 Delta strike was out of the money now, that would be the only time I would write it through. There's no reason to take it into an earnings if you're profitable or even at a scratch. Okay. Now, on the other side of that, the next question might be, what about dividends, ex-dividends? That is going to be baked into the account for the ones you're buying and the ones you're selling. So those are going to pretty much offset. So you don't have to worry about that too much. What was the next one? The impact of the increase in the money options as a result of the volatility increase is less than the impact of the closer to at the money options. Right. Yes, that is correct, Farshid. Do we consider the IV percentile rather than the value of the implied volatility itself? And what's the difference? Okay, so the difference here, Caesar, is every stock and every ETF has its own implied volatility, right? So one stock may always have high implied volatility, and that's just the nature of that underlying. It's just a volatile stock. Whereas something like, let's just throw out an example, Tesla versus a utility stock, okay? And like utility stocks usually have less volatility in them. But that utility stock could be seeing high volatility for itself, and that's what we're looking for. When it is only counted by itself, high volatility. And what I mean by that, so what we can look at, we'll try and find a couple examples real quick. So I mentioned Tesla, and we'll even just look at this ETF, for instance. So this ETF has implied volatility of, let's say, 24. Now, what's Tesla's? Hopefully I can do this off the cuff and come up with a good one. So Tesla's is up in the 30s, right? So this has a much higher implied volatility, and it's below a ID, so it's usually higher than this, basically, is what this is saying. It's not at 50, so it's below 50. It means it has a tendency to get higher. And the XRT was, what's its percentile? 21. So it's a little low also. But XRT currently is trading at, like we saw, 23. That's its percentile, but you can see it's had major spikes, which is going to throw that off a little bit. And Tesla, we can look at Tesla and see that Tesla has a higher volatility. So you can see Tesla has a tendency to really jack around, right? Especially during coming into earnings and stuff like that. It gets really high implied volatility. But implied volatility percent is where it is now in relation to where it's been in the past. And the idea here is when there's really low implied volatility, it's going to have a higher probability of increasing in volatility going forward, okay? And when it has really high implied volatility, it has a higher probability of going back down to the mean, okay? So that's why when you have really high implied volatility, you're kind of expecting volatility to come down. Now, you know, what we've seen today has caused volatilities to go through the roof across the board. And it doesn't necessarily mean that even if I'm selling, say, 3M at 100% implied volatility, that it can't continue to go up. As we can see here, you know, it was at 100% IV yesterday, and today it's still at 100% IV. That means it's at its highest level we've seen in 52 weeks. But, you know, it's not a surefire thing to be able to sell the highest implied volatility being 100%, but the probability is it's going to come back off, and that's what we want to take advantage of. We want to take advantage of that implied volatility coming down, and that is a high probability trade. Vice versa, when it's really low, it doesn't mean that it can't go lower, but the probabilities are when you get that below 30 IV percent, it's going to want to go back up. It's just, you know, it's just the nature of the beast in trading. Does that kind of answer your question? And the way to figure out implied volatility percent, let's just look at something that doesn't have 100%. To figure implied volatility percent, you know, one thing I put over here in the watch list is implied volatility percent. And I have the script for that for you guys that are taking the course and stuff like that you can throw into toss. I don't think it's going to work with everything else, but you can throw it in over here. But you have to reach out to us for that. Anyway, so what you do is you take where you have a numerator and a denominator. In the numerator, which is on the top of the fraction, you have a sum that we got to find, and in the denominator a sum. But in that numerator, we take where the current IV is, which is 22, subtract that by the low, which is 13. So let's just call it 12 for math. Let's just say it was 12. So 10, right? So 22 minus 12, 10 in the numerator. And then in the denominator, you take the high, which is 25 divided by 10, or divided by, sorry. In the numerator, we have 10, because that's 22 minus 12. That's 10 in the numerator. In the denominator, we have the high of 25. 25? Let's call it 26 minus 12. If we find that sum, we get 14. So we have 10 divided by 14, and that should come out somewhere close to 75-ish. So it's just saying where it is currently is in the 75 percentile of where it's been. Okay? That makes sense? Whenever you pay a debit, you are buying volatility, so you should want the volatility to go up. That is correct, Farshad. Good point. Whenever you're buying, you are buying volatility in a sense. In a sense, that's a good way to look at it. But you would, if volatility goes up, you are buying the future expectation of volatility increasing, maybe even, despite directional assumptions and everything else. All right, picking the right underlying. So the right underlying would be something that has a tight bid ask. So if we're looking at something like MasterCard, and basically everything on my list over here does. I'll show you one that doesn't always, hopefully. But we go to the nearest monthly, in a sense, nearest monthly expiration to find this out. And what it should be is 10 cents to the bid ask on anything under $100. And another thing is if it gets over $100, move the decimal place 3 ticks to the left. 15 cents should be what the bid to the ask is. And as you can see here, this one is a little bit wider than that. These are wider than 15 cents to the bid ask. Now, I might bend the rule on MasterCard because I trade MasterCard and kind of know not to give up that edge, but it will make it more difficult to get in and out of that kind of trade. But if we look at something that is comparable in price, like Apple to this, $1.71, we would say move the decimal place 3 ticks to the left, and it's 17 cents. Well, if we go to those near expiration ones, you can see from the bid ask is inside of that 17 cents. Right? Yeah, 10 cents wide there. 10 cents wide there. That is my 1x3x2 that I did for the webinar. It's not working out too well. Who would have thought Apple would sell off? Besides this massive tax sell-off that we've had. Anyway, but that is the rule for that. And then if you look at something like Cisco, where it's under $100, should be at least 10 cents wide. You can see that these are well inside of that 10 cents wide rule. So that's our start for that, picking the right underlying. Now, you don't let, especially if you're a newer trader to options, don't let yourself get caught in the trap of trading something that is wide. Sometimes people will throw out stocks that I've not even heard of, and you'll see that the bid ask will be $2-3 wide. And for it to be $2 or $3 wide, that would mean that the stock would have to be trading 2,000 or 3,000, right? So something like for Priceline, generally speaking, will follow that rule. So it's a $1,700 stock. We move it 3 ticks to the left. It should be about $1.75, let's call it. So you would want to go into the closest to the expiration, $1.75. That puts us at $4.75. It's not fitting that rule right now, but it will during normal trading hours be tighter than that. It's after the close on a Friday, so orders get canceled and people don't leave things in over the weekend. But that's the rule to follow for something like that. All right, you want it to have tight bid ask. See something like Alibaba. It's got really wide markets. Should be 7 to 10 cents wide, and they're like $1. So don't trade Alibaba as a new trader. That's what that comes down to. And again, these are probably a little wider than normal. All right, but that's the rule for picking the right underlying. Now, picking the exit strategy. You always need to know your exit strategy before getting into a trade, you guys, and make sure you stick to this rule. Write it down. Stick to the rules. Stay mechanical. I can't emphasize that enough. If there's anything that I learned about trading or learned from trading, was that my psychology degree was probably more important than my financial degree. Okay? Because the mind will play tricks on you. One thing that we have trouble doing is separating the money aspect from trading. Everybody wants to make money. Nobody wants to lose money. They hate losing. I hate losing money. But to stay mechanical, you have to think about it as probabilities. My probabilities of this are this, because when it goes against you, and they will, you have to stay mechanical, remember your probabilities, and stick with that. If you guys have been watching the daily market commentaries, you guys have seen me talk about 3M and UPS, which are testing my probabilities right now. And I am just looking at it as the probabilities right now. I know my probabilities of being tested are greater than my probabilities of this being wrong. Okay, so at the end of the day, being wrong, because the delta tells us our probabilities and things of that nature. But if you want to learn more about that, I have webinars on that. I don't want to get into that too much for all the newer guys, but know your exit strategy. So this is going to go hand in hand with how you like to trade for the most part. For me, what I look for, if I'm doing that in the money 84 delta call and then paying for it with that short call, I talked about it. Let's say I'm doing it just for math purposes, a $2 wide spread. I paid $1, risk one to make one, right? Where am I going to get out? I'm going to be looking to get out at a 33% or a third increase in that value of that premium. So if I paid $1, I'm going to be getting out at $1.33. The other thing to look at is if it was like let's just say it was a $5 wide spread. I would expect to pay no more than $2.50, right? So when I'm setting up this strategy, I'm going to do this right off the bat, times 1.33, because that's 33% increase, equals, and I'm going to write this number down. At $3.32 probably, I'll round it down, $3.32 I'm getting out. And I write that down on my paper. You can hear my paper flopping in the background. I have like 5 spiral notebooks here where I write down all my trades, why I got into them, what strategy I did, what the environment was in and around that, what I paid for it, and ultimately what my exit strategy is. Now, if you like to trade around Fibonacci or something like that, let's see if I can find something I have Fibonacci on. I think I have something. Let's just say crude oil because I know I have one on that. I know I don't have one. I just removed it because crude oil made a new high. So let's just throw one on there. Let's just say you like to trade off of Fibonacci levels. So I would say that you use your entry and exit levels as those. If you thought it was going to go on a technical analysis of when it gets through this to maybe you would have done extensions or something like that, it goes to that point, I'm going to get out, or whatever your technical analysis says. I'm going to get out at $60 because there's a resistance there. So I would set up my spread to be like the 55-60 call spread, and once it goes up and touches those 60 calls, then I get out because that's where your resistance was. Don't change that. If it blasts through there, don't change that thought process. Write it down. Say when it reaches this fib level, that's where I expect to get out because I see resistance there. With algos these days, they know where those resistances are, and they'll blast through it just a little bit, and then all of a sudden you'll see it really slam down. And you were right, but you didn't get out. So stick with that. Or if you have any support resistances and you say, for me, what I usually do with a debit spread, long debit spread, which is redundant, yes, I know, I usually let that expire worthless. I know my risk going into it. I will ride that into the sunset and hope for it to turn around. If you use a support resistance type of thing and you say, hey, it gets below this support, I'm out. Stick with that. Write that down too. I'm out on a loser here. I'm out on a winner here. And go with it. All right, stay with that. The other thing was if we are looking at the one that is at the money and the out of the money calls, remember when I was talking about the at the money, out of the money calls, we're looking to pay, excuse me, I'm getting a tickle in my throat. We're looking to pay like about a third the width of the strike. So on a $3 wide, we're looking to pay $1. On that one, I'm going to look to take 50% of my max profit. So my max profit on that would be $2. So when I paid it for $1, my max profit is an extra $2, or total $3 is what it would be worth at the very last day. If it increases by $1, I'm getting out. So 50% of that $2. Does that make sense to everybody? If I'm paying $1, max profit is $2, I'm taking 50% of that max profit, which is $1. So when it's trading at 2, I'm getting out. And the reason is because I need to be rewarded for the risk that I took. So I'm willing to take more or I need to take more premium as a winner. Okay. I think I covered all my notes there, and I'll read a couple questions real quick. All right, so let me see here. So that means the MasterCard is 75% more expensive than the previous reading. Are you talking about the IV percent? It just means its current IV, it's at the 75 percentile. It just means that it's at this, if this is the high and the low, that this is landing 75 in the upper 75% of that range is really what that's saying. Right now, it's currently in the 75 percentile of this range. Does that make sense? All right, so let me try and get through this because I'm like getting long-winded on this today, I guess. And then we'll try and go through a couple examples real quick. So max profit. I've mentioned this a couple of times. It's the width of the spread, the short call and the long minus the long call, the width of that spread minus the premium. So the width of the spread is $5. We paid a premium of $2.50. Then that equals $2.50. That is our max profit. So it's the width of the spread minus the premium is our max profit. Our max loss, anytime you're doing a debit spread, is the premium you paid. And then our break even is the long call plus the premium paid. And the beauty in this strategy, when we're paying for that extrinsic value, sometimes we can pay more than the extrinsic value, which means we're paying for some of the, we're paying more of the extrinsic value, and we start paying into the intrinsic value, which means we're paying less for the stock than what it's currently trading. So we're already kind of up. So here's a part of the webinar, and it's going to be really tough for you guys today because we set a low IV percentile of below 30. And as you can see, since today's 1 hour market crash, everything's gotten IV really spiked. So that's something with low IV. Start throwing out things that you guys like to trade, and we'll go through it step by step on the rules and try and see if it will fit those rules. And if it doesn't, there's other option strategies we can trade. If it's 100% IV or 100 IV percent, there's different strategies to trade that have higher probabilities of success than this one. And if we're having to take that risk, we might as well get paid as reward. All right. So throw in the questions box, you guys throw in a couple of stocks. I'll look at it. Somebody was saying Netflix earlier on that they wanted to sell me their Netflix. Let's see if I want to buy them yet. So Netflix, we would have to be bullish on this. It's probably right around a 50 IV percent just by eyeballing it. It looks like it's landing right in between the high and the low, doesn't it? But we could look at it a little further. Let's just see, what's the IV percent? It's 51. So I probably wouldn't do Netflix. But if we look at Netflix, what we want to do during day trading hours, obviously Netflix has gotten a little wide. It's 35 cents, and we should expect it to be 18 cents wide. So make sure that fits the rule. I think Netflix usually does have a lot tighter markets than that during the day. But that's where you look. From the bid to the ask right here, you can see 410 to 445, that's 35 cents wide. 25 cents wide here, okay? So that's where we're looking to meet that rule. On the puts and the calls, near to at the money, I'm not talking about these deep in the money ones, but that's another thing, they follow suit. So the ones that are wide here are going to get even wider deep in the money, and that doesn't matter if it's Apple or Facebook or anything else. Like we could look at something like Apple on this rule for a good example, and as you can see, they get wider right here. They're 10 cents wide, and inside of here, they're 50 cents wide. So, and the reason why, you guys, we want that tighter bid ask in a sense, where Nugget, you can see, has really tight markets. It's 28 cents, so less than $100, we'd want 10 cents wide, and they're like 4 cents wide. And the reason why is because when you're buying these in the money ones, you have to give up so much edge to get in. You're going to have to, if you are right, give up more of an edge to get out. And it doesn't make sense to get churned in that. You're taking risk on. You need to be able to get out of this for better than a scratch necessarily, because a lot of times those in the money ones, if you had to give up like 25 cents to get in, you got to give up 25 cents to get out. And in order to get out, you're going to have to give up some edge. And we don't want to have to give up very much edge. And when there's a lot of participation, a lot of volume and open interest, you guys, that means there's players all in and out, in and around all these strikes. All this open interest wants to see trades happen because they want to get out too, especially if they're short or even if they're long. Maybe they were long up here. They want to get out. They might be at $4.40. You come in $3.33. This guy comes in, all right, I'll go down. I'll be at 338. And that's what free market price discovery is. Somebody sees he goes down to 338 and he was like, I went out worse than you. I'm at 337. And then you get a war going on there where people start tightening up the market because they want to get filled first and they're willing to give up a penny. One thing we used to say on the floor, do you want the penny or do you want the trade? You have to make that decision. Do I want to sit here for a penny or give up that penny to get filled? Okay. But Nugget is a good one. For an example, let's look at USO, only because I'm pretty bullish on USO. If we look at the chart on USO, I don't know what it looks like, but I'm just bullish on energy stocks, crude oil and stuff like that. I think we're in an upward trajectory. We keep seeing, and these are the things that I'm going through this only because these are the thought processes you guys need to come up with for your market assumption, right? If you have a market assumption, write that down. Like for me, if I'm going to trade USO, I'm going to be looking at it thinking, okay, the last inventories for crude oil were down by, 1 million barrels. We had a drawdown of 1 million barrels. Overall, global economies are looking pretty robust. FOMC is, seeing good economic data from manufacturing side. Manufacturing takes a lot of crude oil. They take the distillates to make plastics and things of that nature. That's demand. See higher demand, inventory is going down. That means supply is going down, demand's going up, prices go up, right? Economics 101. All right. So therefore, I'm bullish USO. I also like to do this when I've seen like a 10% correction on a stock. That's why I like to put on those call spreads also. 10% correction, volatility's gone down. You can see volatility is really low in USO. So let's look at USO and see if it follows that rule of tight bid ask. Right here, we've got penny wides. It's only 14 days. We could even go to the 49 days. It's 2 cents wide. It's only a $10 stock, so we'd expect it to be pretty tight. Now, I want to go out. I'm going to start looking at that 71 days out, and I'm going to, look at support resistance. $12 probably is where I'd look to have it go, maybe even slightly higher. So $12 at least. So let's go and look at the delta and all that. So I said about the 84 delta. That puts us right there. That's as close as we're going to get. 10.5. So I'm going to buy the 10.5s here. And then look over here. How much extrinsic value is there in this option? 13 cents, let's call it. So I need to sell something that's worth 13 cents. That gets me at the 12.50. $1.14. It's $2 wide. It's a little rich, right? It's over that 50% the width of the strikes. But one thing we can look at, let's just double check to see if we paid for all the extrinsic value. It's trading $10.50, paying about $1, let's say $1.30. So this is $11.80. So $11.80 to that, 80 minus 67, that's 13 cents. So we did do the extrinsic value. It doesn't fit. So we move on. What do we do? Well, let's just go a little bit further out and look at those same strikes in a sense and go with see if it works out. This is about that 84 delta again. So we're going to buy that one and then look to sell something that has 18, 19 cents, which is that same strike. And it's closer. It's not quite as good as what I was looking at earlier today. I was, let's see. So let's just look at it again. So when I looked at this earlier today, it was working out. So let's look at this one and then selling the 13s. So the 13s, we've got $2.50 wide, $1.23. So I'm paying less than that 50%, right? Because $2.50 would be $1.25. So I'm paying less than $1.25. Now, if I look at this though, I have to be pretty bullish on this because one of the things is we add, where's my break even? We add the $1.23 to the $10.50. That gives us 11.73. So 11.73, it last traded at 67. I've got to go a little bit higher in order to make sure I get to my break even on that. But it fits the rules there. All right. Didn't pay probably all of the extrinsic value, all but what did I say? It's 73 and it's trading 67. So 6 cents. Do I have to worry that much about it? That extrinsic value, I don't think I'm too worried about 2 cents or 6 cents over the course of about 100 plus days. So that would be something I would look at. Now, even though I picked that stock at 13, I'm going to be looking at what do I want? Increase in value, 33% increase in value or a third increase. So 1.23 times 1.33, which is that increase of 33%. It's just an easier way to get there. $1.63, maybe $1.64. So I'd write that down. Exit $1.64. Entry is $1.23. Bullish on crude oil. Inventories were low. Economic data showing robustness globally. And I'd write all those things down. Why I got in, why I'm getting out. Now, having said that, if I was thinking it was going to go to 12.50, that might be the other place that I look to get out at. One or the other, whichever comes first, kind of thing. Does that make sense? H, do you got some defensive stocks you want me to look at? I saw you threw in there defensive stocks. I didn't know what you might want to look at. If it's something low, when, I could look at it the same way. When I think is bullish because of global economy is doing well. They're starting to do really well in Macau. The Asian region loves to gamble. And, you ever go to a Wynn resort, there's never a lack of people there. They're actually one of my favorite ones to go to. But I don't gamble. I go and hang out at the pool and stuff like that. But I don't like the probabilities of sitting at the table. I'll do it for fun, but I know I'm just doing it to pay for light bulbs, really. I do it to hang out with my buddies when they're all doing it. Anyway, so we can look at Wynn, see if it follows that rule. It's $159, so we need it to be around 16 cents wide. So that puts us at 80 cents. Of course, nothing's working in my favor today, but that 70 is 80, 85. Why are they so wide right now? Friday, very volatile Friday. Nobody's leaving anything in over the weekend, so it's not giving me very good examples. But anyway, Wynn usually does have tight markets. So let's just look at it and see if we can get this to work out. So I want to go out about 100 days then, since that's my best option, the March. And then I'm going to look for the 85 delta, and because it's a high price stock, we're going to have to pay more for it. But on the flip side, we don't have to pay as much as if we went out and bought Win stock. We also don't get the dividend. Yes, I know we don't get the dividend. So we're looking at trying to get about $1.80, and we got to pay for about $1.80 in extrinsic value. So let's go a little further out. Win has low implied volatility percent, as we can see there. So about $1.80. That's probably this one. And what you will notice is that when you're doing the one standard deviation move here, which is that 84 delta, that's one standard deviation move to the downside. One standard deviation move to the upside is the flip of that, the 16 delta. So that's really what you're kind of looking for to sell. So let's start out with going one with that's a little tighter. And we got $50 wide. $50 wide, we want to pay no more than, $25, and this is well off. So let's see if we can move it up just a little higher and see if we can get better pricing. So I'll probably have to do the math in my head real quick. $55 is $27.50. Is that right? I got a little bit closer, but it's still not there. So that one's not going to work. The USO one works pretty good. But you're just going to have to go through those and figure it out. You might be able to go out even further and just say, hey, but you're going to be paying more. Keep in mind the 84 delta, 125s. You're also going to have better reward. Also, $3.20 I got to pay for. So that's probably right around here. Those are really wide. Oh my God. So that's not going to work out. But you get the idea. Something in Apple might work, but kind of play around with those. Try and get it to work out to where it's as close as possible. What is it? RTH. HH is saying RTH. So this is part of the retail. So one of the things is it's got a higher implied volatility percent, and I don't trade this stock, to be quite honest. But, first blush, it's a $88, $89 stock, so it's below 100. We want these to be 10 cents wide. Now, this could be experiencing the same thing we've seen on all the other ones, but make sure that, during day trading that the bid offer is closer than this. Because if you think about it, when you get in and get out, right, if I had to give up, it's trading this wide, 35 cents. If I had to sell these at like 90 cents, well, think about it. Over the course of time, I may if nothing happened, I may have to bid up to $1 just to get out and give up that 10 cents because I have to give up extra edge to get in, and then I have to give up extra edge to get out. And one of the key indicators of that is going to be volume and open interest. And you can see even with 14 days to go, there's almost no volume and no open interest. So that's something you can see like on Priceline, even though it's giving us really wide bid offers, inversely, you can see that there's a lot of volume and open interest on a daily basis. Well, it's not a lot, but there's pretty good volume and open interest on a daily basis. We look at something like Apple, and it's going to be like through the roof. There's people falling over each other to give you a better market in something like these. Just as an extreme example, Lowe's you could look at usually has pretty tight bid offer. Of course, it doesn't today, but you can see they have good volume and open interest. RTNN as in Nancy. Funny. But that's how you do that. And stick to those rules, you guys. You can bend it by a little bit. $5 wide, you got to pay $2.56 or $2, but try and keep it less than the width of those strikes because you need that profitability aspect of that, all right? Does anybody else have any other questions? Real quick. All right, so we're offering this special right here. It is in the it's going to be here in just a second. The chat window, I got a link here so you don't have to like write it down. So you can go in there and click on that link in the chat. We've been communicating back and forth through the questions. In the chat window, you can click on that link and it should bring up a extra window like this. This is what it just did. I just double checked it, so it should be working. I've talked about this a lot, and I can't emphasize it enough. If you're trading with probabilities and higher probabilities of success, you're going to be a better trader. I mean, there's just no doubt about it, right? If you can trade higher probabilities, you are going to win. No pun intended. Talking about casinos, they trade, or they are in a business of having all the probabilities in their favor. And they didn't build those massive places and all those light bulbs by losing money. They know the probabilities are in their favor. Just like if you're winning at the table, they're going to ask you to stay the night. Hey, stay the night on us. Well, they're comping you a couple $100 room. Why? Because they want you at that table. Because they know the longer you're there, the higher probability is that the probabilities are going to turn back into their favor. You're beating the probabilities in the meantime. That's one thing my friends hate about me is when I play in poker. As soon as I get up, excuse me, let me take a drink. As soon as I get up money playing poker, I walk away. I get up and leave. And they're all mad. Well, we got to have a chance to win our money back. I'm like, no, no, I am not playing that game. You also have a better chance of winning my money. I'm walking away. So I do that. I get up and I walk away. Or I'll take what I put down on the table, what I risked in the beginning, and if I make that money up, like if I double it, I take that money off the table that I originally bet, put that in my pocket, and when I lose that pile I left on the table, I'm done. I'm out of scratch. But having said that, trading with higher probabilities of success is the way you guys are going to get ahead. And this particular how to trade like the Wolfman gives you pretty great in-depth trading with delta, how to measure the odds of winning trades, all of those things, how to measure the theta decay, history of options, which is a real fun one. I've been talking about this in the daily market commentaries a little bit, protecting your portfolio with rising interest rates. Interest rates are going higher, you guys. That's a fact. Another fact of the matter is when interest rates go up, bond portfolios go down in value. Yeah, you keep getting that coupon, you keep getting that money, but higher yield is out there and people are chasing that. You can't chase coupon, you can't chase yield and win in this game. It is a losing man's game. If you have bonds in your portfolio, which 99% of people do, what you have to do is trade options around it in order to get ahead. Otherwise, you're going to get decimated. All right, and then protecting your portfolio with options, a little bit more detail on options terminology, all of those things. I mean, you guys need to be trading with this knowledge for sure. And if you like my instructions, especially if you are some of my regulars, you need to be taking advantage of this as well. And you have a chance to get it for 36 bucks. So take advantage of that. And the best way to become a better trader, you guys, is to constantly learn, which obviously you guys have made that decision because you're participating in this. But wouldn't you say that, just knowing technical analysis and how, if you came into this and knew how to do a call spread and learned something from it, just knowing how outside world trades a call spread or technical analysis and how I trade all of that stuff, that you're going to increase your probabilities of success. I mean, I go through specific rules to keep you mechanical. Those guys aren't going to tell you when they think you should get out. They're going to tell you to ride that into the sunset till the last possible day. And that is not a way to set yourself up for success. The idea is hitting singles, doubles, and triples and taking your money off the table, just like I talked about with like the casinos. I mean, probabilities are against you, especially with a strategy like this. Take that money off the table quickly, walk away. Don't stick around at the table. Take your money and run. So take advantage of that. Click on that thing when you say it's right there in the chat window. It's easy enough. If you're watching this on tape delay, just pause it and punch this into your URL. It's about as easy as that is. This is also the same link. You can pause it here too, but I just want to thank you guys all. Later webinars, I'm going to be drilling down on option components, trades I find, when and where I find them appropriate. And you can also reach us at 310-598-6677 or trading@protraderstrategies.com. Also, I can't emphasize you guys should really take advantage of those daily market commentaries because I talk about every single trade I do, when I get into them, when I get out of them. I don't cherry pick the winners and the losers. You know, like you're going to watch some webinars from people and all they're going to do is talk about their winners. Oh, you could have been up 300%. Well, yes, you could have. But I talk about those in detail and how I'm staying mechanical, like how I'm, you know, dealing with a short strangle that's going against me, how I'm going to increase my probabilities of success or what I'm going to do. And, you know, hopefully it gives you a real insight to how to stay mechanical. And I see you guys are blowing me up. I'm going to try and catch up here in a minute on some of the questions once I get done. But just want to emphasize how important this particular course can be to you guys. And it's got some really fun stuff in there, like the history of options, who the first person was who started options, and there's a lot more. So this is over probably 12 hours of information. Farshid, thank you. I appreciate the kind words. I think there's a couple of questions in there. Do you have a webinar on how to trade the volume profile? I do, Caesar. Just reach out to us either by email at trading@protraderstrategies.com or 310. As a matter of fact, I think it's actually in here. Is it set your trades up, protecting your portfolio, income generation? I thought it was in here. Maybe it's not in this one. Oh, using market profile to trade options. Yes, Caesar, it's in here. Great webinar today. Thanks, H. Appreciate it. Turn those machines back on. I agree, Rick. Why does it have to be the weekend? Especially after a day like today. Man, you're no fun to play poker with. That's right, Farshid. I'm gone. As soon as I take your money, I'm walking. You re-ante up, then I'm walking. Will you send me the recording as I have missed most of the webinar, please? Eileen, we will be sending this out. I believe I got it taped this time. So we will be sending this out. It takes a little while. I got to compress it, upload it, do all those things. It should be out usually by Saturday, though. And then one thing, Eileen, I suggest rewatching it too. All right, thanks. Thanks, Farshid. Appreciate it. Rick, you are too funny. I wish I could say some of your stuff on webinars. Anyway, appreciate it, you guys. That's all I got for you guys today. If you can't take that, take it easy. JQ on the ball again. Take care, you guys.